Is your friend Ibrahim. Today I will be taking you on cost of capital, module 2. At the end of this class, you should be able to understand cost of capital, equity, and debt. Let's quickly define cost of capital. Cost of capital is the required return that investors are expecting from their investment. Every investor is expecting a return on its investment. It could be dividend, it could be capital appreciation, which is the share price growth, or interest. Now, the cost of capital, it is usually a cost to the firm because it's a source of finance. Please, kindly go back to my previous video where I explained um, the sources of finance. I made mention of the sources of finance, cost of capital, of which we are treating the topic now. So, the cost of capital, I will take it again. Cost of capital is the required return that investors are expecting from their investment. Equity holders are expecting dividend or share price growth in their investment, while the debt holder are not expecting. It is requiring the borrower to pay the lender what is and when due, which means that they will need to pay the equity holder before they will need to pay the debt holder before the equity holder. Now, cost of capital is divided into two. Here we have the cost of equity and the cost of debt. Now, I will start from the equity. 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 Equity holder are expecting dividend on their investment or share price growth. Share price growth on their investment. Now, JITCO or Fidelity Bank may decide to pay dividend at the end of the year. Sometimes they may pay at the middle year for aggressive investor who needs returns on his investments, while share price growth or capital appreciation, it's also known as capital appreciation. Capital appreciation is also known as capital appreciation. Capital appreciation means that when there is an increase in the market price of when there is an increase in the market price, we could say it is a what? Capital appreciation. So, in a nutshell, the cost of capital is divided into two, which is the cost of equity and the cost of debt. What brings about this is because when a company wants to finance a project could be bond, a project could be capital project, a project could be shares, could be treasury bill. So they need a sources of finance, which I've mentioned earlier in my previous video. Now, either the company will go by equity or going by debt. What is equity? Shareholders are expecting returns on their investment. The investment could be dividend, it could be share price appreciation. So the dividend could be paid half of the quarter and also at the end of the year. Or they go by share price appreciation, capital or share price growth or capital appreciation, whereby there is an increase in the share price. They may decide to buy the shares at the rate of 5 naira as today. In the next 2 months, it could be 10 naira. That is share price what? Capital appreciation or share price growth. So in my next video, I'm going to explain cost of debt. Thank you.